From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, July 9th, and we've got the great John Dick with us here today to talk about how people think about things out there, the economic sentiment report. We also have John Fagan and Brendan Walsh from Markets Policy Partners. I'm Tony Fratto from Hamilton Place Strategies. And John, why don't we just dive in right off with the ESI? You know, we've been talking about the way people think about things like inflation and direction of the economy and their personal finances, and we've got some data on that now, don't we?
Yeah, I mean, so this was our first of all. Thanks for having me back. Great to see you guys again. This was the first upward movement in the ESI we've seen in close to 2 months, I kind of characterize it more as a correction, I think, than I do a trend. It feels to me like some of the negativity we were feeling from consumers over the last 2 months was, I don't want to say unfounded, but maybe a little bit melodramatic in terms of how people were reacting to like the sense of inflation, right? And because we talked about last time I was on here, like inflation's that one word that the one economic term that consumers think they know because it just means I paid more for something today than I did yesterday. And you know, consumers felt that. They saw it at the pump. They saw it at lumber prices, right, when they were trying to remodel their homes. And I think there was some overreaction to that, fearful overreaction to it that seems to have corrected itself, or at least sort of maybe righted itself a little bit. And so we saw, you know, things bounce back a little bit this last reading. You know, things like fears over the housing market and home prices seem to have subsided a little bit. People are definitely still feeling better about their personal financial situation, and there's lots of things contributing to that. I know we'll talk about later. The one metric that we track that was still sort of like a little ugly was people's outlook, 6-month outlook for the economy. And again, these are consumers, not investors. And it's pretty clear when we look back over the last, year and a half and change, that outlook is driven very heavily right now by people's virus concerns, right? And the emergence of these new variants and concerns that we may start to see spikes again and what's going on globally and travel seem to just have the consumer a little bit on edge about just sort of the 6-month outlook. And that was really the only ugly mark in the ESI this time around.
Yeah. It seems like, obviously there are always spikes in the attention span, but I think you're right? I mean, we had these, the like headline day after day on lumber prices and the things that you need in your home, or like things that and can touch and understand. And I think it definitely had a pretty significant impact on the way people thought about things. To me, like that's still always like the used car price is one of the most, just my favorite ones, right? The fact that, because it seems counterintuitive, that prices for the used thing that you're getting rid of are going up rather than down. Things must be really wacky in the economy if that's happening.
Because that's the narrative. The minute you drive it off the new car off the lot, it's worth 20% less, and
right.
In the last year, it's worth 40% more.
Right, like it's always ingrained in your head. That new car that you buy is always going to be worth less. So used cars spiking seems like, man, things are really screwed up in this economy. Right.
But it speaks to there's irrationality, I think, when you ask the consumer economic type of questions. It's driven by emotion. It's driven by fear. It's driven more than ever by politics. I mean, we've talked about that ad nauseum when I've been with you before, because it's sort of like I'm more worried about a downward trend depending on. I'm more worried if my political party is not in power, because I don't trust the people who are in power to be able to fix the problem. And that's what we see. And we know that's irrational, but it matters, because if it actually affects consumer behavior, then that's when the rubber hits the road, right? Are they spending less? Are they? And I will say, I mean, consumers being more concerned about new variants of COVID will affect their willingness to travel. It will affect their willingness to go out into crowded public places, and that's going to affect where and how they spend money. Now,
when you think about the concern that we had and this is going to be like part of our discussion on on how markets are thinking about inflation as well. But look, if you think there's nothing good about having the Delta variant out there. Let me just stipulate that. But a little bit of a check on runaway growth might not be the worst thing to sort of Goldilocks the economy a little bit. Let people take a pause on buying things. I'm going to see more economic activity, but I'd rather see it spread out a little bit more rather than super spiky, where we have problems with supply chains and things like that. I like smooth activity rather than spiky activity.
Well, agreed. But none of this changes the fact that the average U.S. household is sitting on a lot more money than they were sitting on 18 months ago, right? And I'm not sure this will necessarily slow spending. It just might redirect it again. Like it might go. We were anticipating this huge explosion of experience buying in the wake of like people not being able to buy experiences for a year and spending all that money on goods last year, but they may choose to slow the spending and experiences, but it might go somewhere else, right? It may not go to restaurants. It may go to, more outdoor stuff. It might be, Tony, we've talked about one of the things I've just found yesterday in some of our data that was super fascinating was like this significant decline in the number of Americans who cut their own grass. Which seems like such a simple thing, right? But like since January, the number of Americans who say they mow their own lawn has dropped by a full 15%, which is like in our numbers, it's just like a huge.
As my first entrepreneurial effort, which I did for many years, was lawn service. So I'm happy to see that, that the lawn service.
Yeah.
My 14-year-old lawn service business was did pretty well, but you're saying it would be thriving today.
Yeah, because I'm sure a lot of people stopped because you weren't going to the office and you just wanted to do something, so you started cutting your own lawn. But now you're back in the office, so you need someone to cut your lawn. It's probably a pretty good economic indicator.
Well, a little bit though, Brennan, but we didn't see it go up as much last year.
Oh,
yeah, right. So it was pretty flat. I mean, I actually
means
think
you have more money.
People have more money, and and so like I can spend my money to buy things, right? Yeah. Shoes, kayaks, not shoes, but kayaks and stuff like that. We knew people were buying like crazy last year, RVs, whatever it might be. You can spend your money on experiences, which is tickets to concerts, restaurants, and what have you. And now there's this sort of like sense of maybe people are actually using that money to buy time for themselves, right? Yeah. Like, I don't know how many people actually enjoy mowing their lawn. They might say that they do, but wouldn't they rather spend that 2 hours like hiking or playing 9 holes of golf or something, right? And maybe that's what we're seeing. It's just the money's going to go somewhere. It's just where's it going to go until it runs out, right? Yep. I would worry about like if we see significant surges increase, like what's that going to do to restaurants by the fall and winter when we can't eat outside again? But we're not there yet.
Are you seeing anything in your numbers about a back to school? We're already getting some estimates from consultants and analysts about the back to school season. Do you have a sense of how that might be shaping up, or what are you going to be looking for in particular?
Well, I mean, it's going to obviously be way up. What's interesting is if you look at not just our data, but like the NPD group who sort of has the currency data on like retail spending, back to school started like in March. Right. Like it was wild. I mean, it was really, we think about
our kids went back to school in April. Yeah. So,
yeah, I mean, but like people were buying their kids clothes because it was like, all right, my kid's going to they were starting back to school. A lot of kids were just starting. We're literally starting back to school in the spring. And so it's going to be stretched out further. But it's going to be a monster, right? I mean, because like these kids didn't buy new clothes last year. And most of them, the clothes that they outgrew or whatever. So yeah, I mean, we're very optimistic for big back to school, pretty optimistic for holiday, depending on that's still an eternity from now. But we saw like at Amazon Prime Day, which was sort of did not grow the way it has historically grown, because a lot of people have been shopping online pretty regularly already. It wasn't like the novelty, but
Great point.
The one category we did see higher spending though was in apparel. That was the one thing that sort of spiked this year on Prime Day, was people buying clothes, which normally wasn't something they were buying heavily on Prime Day.
I can't help thinking that September is the real test on this. I mean, I feel like we'll get a sense of some of this as we get through, but on all of these pressures, when people are in fact back, families are in fact back to schools. So many businesses have put off back to office until after Labor Day. The unemployment insurance runs out in September. It's just, you have this confluence of things in the way people structure their lives that will be really interesting. And I think when we're, on the Macrocast at the end of September, looking back, I think it's going to be, really, really interesting to see how a lot of that has played out. And the first jobs report in October, the September jobs report, which we'll get the first week of October, I think is going to be really fascinating.
I think that plays a big role in Fed decision, where Powell's saying, let's wait to see what September jobs look like when kids are back in school and the work to childcare behavior is, before we start talking about taper, and I think it makes a lot of just logical sense.
Can we get into that a little bit of going forward? I mean, John Fagan, markets, John and Brendan, markets, it seems like there's a different outlook, right? Right now, right? Like we were worried about like a runaway train, and maybe the train isn't runaway at all. Is a drag on the train.
Yeah, overheating and inflation fears. That's so March, April, May. It really turned on a dime to some extent. It had been kind of calming down to some degree. You could see some of the scare story had come off. The market reactions to inflation, U.S. inflation data releases weren't as panicky as they had been even earlier in the second quarter by we were getting into May. But it's market-based gauges of inflation expectations, whether it's inflation swaps or tips break-evens. Those have topped out pretty decisively in May and have come down from there. That coincides with lumber prices and some of the signifiers that we've mentioned of that psychological sense of inflationary pressure coming off the boil as well. And really, it's now market-based gauges of inflation expectations are not really all that far out of line with where the Fed would want them to be. This morning, the 10-year was at 2.25%. I think the Fed would love 2.25% inflation, and that's coming down from 2.58% in the middle of May, which was trending higher, and people were beginning to bite their fingernails. The 5-year break even was 2.8 and looked like it might be marching toward 3, and it was beginning to impact market sentiment. But now we've pivoted dramatically over the course of June, and for a variety of different reasons, into the overheating risks have morphed into concerns about the fortitude of the recovery and whether
is it a question about the fortitude of the recovery, or is it the market correctly reading the signals that it's gotten from a run of Fed officials who said it's time to start talking about tapering? They did signal that we're ready to start having these conversations, and so that tells me that the Fed is ready to start engineering a slowdown. I know it's like overly dramatic way of putting it, right? Like taking the froth off a little bit is not engineering a slowdown, right? But it's engineering a slowdown from prior anticipated overheating expectations. You're engineering a slowdown, and market says, I'm going to step away.
The two are definitely related. Obviously, the Fed has played a role, the June meeting being considerably more hawkish than expected, with those 2 rate hikes in the median projection jumping forward into 2023, and the projection about inflation going up a full percentage point to 3.4% this year. It was taken as hawkish. That broke the ice on talk about the taper. And really, it's been the hawks on the committee, or what passes for hawks on the committee, that have had the megaphone over the past few weeks. And the commentary from Dallas Fed President Kaplan, St. Louis Fed President Bullard, chief among them, but Atlanta Fed President Bostic and others talking about the appropriateness of the discussion and now gently advocating a start to the taper. But that's not clear. It's not clear that the center of the committee is really there. Yeah. And we've certainly heard New York Fed President Williams come out on the other side of this saying substantial further progress toward their full employment and price stability goals, which is the condition for tapering, have not been met in his view. And it certainly seems like Chair Powell is with Williams on this one. We'll see where the communications come out over the next few weeks. But there's a sense that maybe the hawkish wing is still a minority, but their views have been magnified. But that's coming at a time when U.S. economic data, we saw those two in a row disappointing non-farm payroll numbers. The last one was a good one, but it had that strange increase in the unemployment rate. We haven't had like a really clean, big blockbuster labor market number. Last week's initial jobless claims ticked up a little bit. There's been enough muddiness in the data to induce uncertainty over the past couple of months. While the Fed is turning hawkish, market participants are looking at the data and beginning to scratch their heads. And the Delta variant and those, we haven't even heard a Fed official, I think until this morning when San Francisco Fed President Daly mentioned the variant. It was like the first time I've seen a Fed speaker talk about the potential impact of variants. I think that markets have keyed in on that. They felt
I would also add global growth. Global growth has really slowed down, and that's entirely Delta variant related.
China's central bank just eased monetary policy. They announced it on Friday, and they cut the reserve requirement ratio this morning 50 basis points.
No one
had moved that in a year. Yeah.
No one was expecting China to do that, were they?
Well, they told us a couple of days ago, but before a couple of days ago.
You said us a week ago this was coming. Did anyone think this was coming a week ago?
No. They announced it end of last week.
Yeah, whenever the day, But before they announced it, it was not expected. Right.
Yeah. All right.
And this is also, and just it's probably not the major factor, but it's also coming at a time when reality is setting in to investors about what the Biden administration can feasibly achieve on the fiscal front. Remember back in February when they had the sweep in Georgia and everybody thought, oh my gosh, it's MMT, modern monetary theory. They're going to spend $5 trillion in the first year and monetize it all, and the entire U.S. economy is going to go up like a rocket ship. Well, they're struggling to get $1 trillion bipartisan package. There's a lot of sausage making. The expectations of the most muscular kind of expectations of fiscal spending have come off a lot during this period of time. So it's all kind of a lot of these factors have come together, and it's probably overplayed in the markets. The markets are probably overreacting. And we think that it's going to resolve to the upside in terms of growth. But and we think that the Fed doves kind of hold off the hawks for quite a bit longer here. But the markets are pretty uncertain about it. And it is a sloppy, choppy summer for macro, definitely.
When do we see them again? When's our next FOMC?
Is it the 20? I think it's the 28th.
Yeah.
End of the month.
Yeah. So that's going to be an interesting presser.
No question about it. And the case to be made for the taper depends on this definition of substantial further progress. The hawks think we've made it, and the doves haven't defined what they think substantial further progress really is. I think it's incumbent upon Chair Powell to describe it.
Yeah, and you would have to imagine it has something to do with Powell's pushback will be around the labor market, that there's both 9 million job openings and also 9 million or 7 million people that can't find a job. So something's wrong with the economy right now, and we got to fix it.
I mean, it does. Are there technical factors also, though? I mean, everything we said is true. The 10-year at 129 or whatever it was I saw earlier on the screen, right? Like, are there technical factors that are?
There definitely was. So much of the street was short a month ago, and then was just wrong and had to cover. And now I think we're at the point where, so Deutsche Bank put out a report a couple of days ago saying that the Fed is the entire incremental buyer of the of treasuries. So they could be, QE definitely is probably helping to drive rates continued lower at this point, because there's no one has the guts to short again.
Yeah, and supply, we haven't had a lot of auctions.
Yeah, we really haven't. Yeah.
So supplies, treasury supply is coming up. There's the positioning, supply, technical factors, market participants being caught offside. It's probably, all else being equal, it's probably amplified the move. Mm-hmm. But to ascribe technical factors as the major, as really distorting the treasury market, I always hesitate to do that.
Yeah. The treasury market helped to overshoot a little bit, but the move was, I think, fundamental.
Yeah. It's too big of a market to have.
Yeah, the directionality of it is sending you a message, and the message that it's sending is, we're the reflation picture is not what we thought it was going to be in May. Not a disaster.
The
yield curve isn't inverted. It's not, nobody's panicking, but the Fed doesn't appear to be the hell bent on reflation. The damn the torpedoes kind of reflation posture that people thought, and the Biden administration is not the fiscal, the fiscally aggressive and just incredibly spendthrift that some on Wall Street thought that they would be.
At the same time, though, this narrative has changed over 3 weeks or a month, right? I mean, if you had looked at, go back 3 weeks or a month ago and look at inflation, we were talking about it here for good reason, because we had more inflation in the first half of the year than people were predicting for the entire year.
Right.
Yeah. I mean, and the question was, how much of that is baked in? How much of it is transitory? It just tells you like sentiment on these things can change pretty quickly. And, here we are. We're like, no one's afraid of inflation anymore.
It's also, again, back to the technical factors, it's also summer trading. And this is, of all summers, this is probably the one that, you need to take summer market price action with an extra grain of salt and maybe a few extra grains this summer, given everything we've been through.
Hey, John Dick, on some of that, the fact that it is summer, though, have we seen, I saw some of the airlines talking about, where they are in terms of capacity levels or activity, flight levels relative to pre-COVID, which is like obviously still really low. The international side of it is, just way, off a cliff, right, and hasn't come back. But the domestic travel has come back quite a bit, though. And are you seeing some of that?
Yeah, I mean, absolutely. But slowing in the last couple of weeks, right? Yeah. I mean, people, we published this airline monitor, and which is essentially people's, have they flown? Are they intending to fly? We look at various airlines or whatever. But I mean, it was going great until 2 weeks ago. So the most recent report on it isn't awesome. And for, again, for really obvious reasons, you guys are making me think, and this is, I don't want to get too far in the clouds on this, but in our world, when we talk macro from a consumer standpoint, we're thinking about macro trends in the consumer population. Mm-hmm. And one thing that no one, and I'm certain the Fed and others aren't thinking about this stuff yet, but huge question marks we have are about massive value shifts in the consumer population that we believe are permanent, right? Like over the last year and a half, people were spending more time outside, more time with their family. People left the workforce that we think may not go back to the workforce. I mean, we mentioned already, mowing your lawn, but there's so many, there are passion categories we track, like fashion, art, people have just lost interest in those things last year, for obvious reasons, but it doesn't seem to be bouncing back at all, which means the consumer's attention span has shifted somewhere else, particularly when they're sitting on more money. So what is that going to mean long term, right? Like entire markets are going to be, consumer markets like retail and apparel and other things are going to change in an unprecedented way. And so what is that all going to mean? I have no idea. I don't think anybody does, but we are just now beginning to feel permanent change, right? Like we wondered what was going to outlast the pandemic. These are things that the changing values of consumers. Like, oh, maybe I was able to do pretty well with one income in my household because, we were able to cut back on spending in certain categories and I did more stuff with my kids. Maybe I don't want to go back to work, right? Yeah. The long-term implications.
I think that your data is going to be as valuable to policymakers going forward as the traditional data. I saw a survey today. It's 70% of people that worked in hotels and restaurants do not want to go back to that job. They want an entirely different career after that. That's a lot of human beings.
Sure.
Some of them are going to be forced to go back, but that just shows you that we have, as a culture, have changed. And you can't necessarily make policy based on the old assumptions of how people behave, both in the workforce and in how they spend their money.
But you make, and again, I don't want to focus too much on the one sort of insight about people mowing their lawn, but it's a good analogy. It's a good metaphor, I think, for maybe lawn care, per your comment earlier, Tony, maybe that becomes like a booming industry because people right. So now maybe the people that worked in other service jobs decide maybe that I'd rather work in lawn care because I get to be outside all day and healthy and active and I
saw an interview. There's a publicly traded pool company. They put pools in your backyard. And once this came, a huge short interest built in it because everyone figured, well, that's over. No one's going to build any more pools. And the exact opposite has happened. He's booked for 2 years because people kind of liked staying home with their family and having a pool in your backyard. And you realize that it was worth, and also you probably just built a monstrous amount of equity in your house. So cash out and put a pool. And because your family stays home and the kids have fun and you have a barbecue over with the neighbors. So
yeah, look, I don't question the capacity for this economy to deliver, to supply, to meet the demand desires of consumers here. Like we'll figure that out, and it'll happen it's already happened in lots of different ways 1,000 times over. And I'm happy with it as long as it reflects, sort of natural, choice decisions by consumers and natural choice conditions by labor. We have lots of places in labor where the things that the president is announcing today, his antitrust executive order. One of the things he's talking about are licensing and non-compete contracts, things like that, right? That are barriers to people switching jobs and labor mobility. So a really important topic. What came out of COVID that I think is, on one side is beneficial, which is what John just talked about, which is households deciding we have a desired lifestyle that we really learned that we enjoy, and we want to go do that. I have a concern that is overwhelmingly the choice that it's women who are making this decision, and I, as an employer, want access to the best and brightest that the economy can send to me. And so I don't like the fact that a large percentage of women are dropping out of the workforce, because that means I have to hire a dude who may not be as smart and talented as she was, who decided to make the lifestyle choice to stay home, in which case she says, I'm available at a price, so if I really want to pay for, I'll pay a higher price to draw her back in. The ones that are unnatural that I don't like are the people who are at the top of near the end of their careers. They're 50 and above, and have been, maybe they're running a very highly productive, high margin, small business, very happy in their lives, and COVID kneecapped their business, and it's too hard to go back in. They lost some money, they're a couple of years older, having trouble with supplies, having trouble getting workers, And so, and you realize that you're near the end of your career and you've saved up a little, retirement money. And so you concede and go do that. Well, that was a highly productive part of the economy that's going to walk out and not be contributing for the next 5 to 10 years like it otherwise would have been. That's a loss. That's a permanent loss to the economy. And so I those are the ones that give me some pause.
No, that's a good point, because in normal times, you would have transitioned that business to someone else, and now you're just shuttering it.
Yeah, that's right. And that's happened with, I mean, I don't know the number. It's got to be it's at least the thousands, and maybe it's the tens of thousands.
That's a really important insight. Yeah.
There's the commentary from some industry leaders in infrastructure about the American Jobs Plan a number of months ago was that one of the big problems will be they're not going to be able to hire people to do some of these jobs. And now with the labor market showing some different kind of dynamics than we expected, a stylized example would be some of these people that don't necessarily want to go back to service jobs potentially could have some jobs opening up in a new field, in a field that they're more excited about. So it's that are based on rebuilding America and so on and so forth. So that's a stylized example, and certainly I'm sure the West Wing has that in their conceptual policy map.
Yeah, those are big questions though, and I think they're. As John said, he focuses on them. That's the way he thinks of macro changes. I think it's there's macroeconomics, but those macro moves to how really big cultural changes are way more powerful, really, than anything that government does. Changes in sentiment, the way people think about how they want to live their lives is way more. Far more powerful factors, but also just much harder to predict, right? I mean, like swimming pools, how directionally off, we talked about this the last time I was on, how directionally off we were on our anticipation of where the economy is going to be when we were having this conversation back in March of 2020, right? Way off.
Isn't it funny though, Tony, because we've been screaming since last March that the consumer was going to have way more power over how this thing unfolded than any government or governor or state or, company was going to have. And that's continued to be true. And we didn't anticipate a lot of the things that happened, but then you look back on them and they make perfect sense, right? So
totally.
They shouldn't be as hard to predict as they are. Your point about women in the workforce, and I know you mentioned you feel it, it's 100% true. We know that, but one of the things that's shined a huge spotlight on is just the income, the wage disparity between men and women in the workforce, right? Women are still making 80 cents on the dollar compared to men. So when families were saying who's going to stay home, it wasn't a coin flip, right? Because the odds are if the female member of the household was probably making less money in the same job than the man was making. And, maybe this will correct that. If we're going to get those women who left the workforce back into the workforce, we're going to have to overpay them, right? Or not overpay them, but pay them more than we were paying them before. And maybe that's a correction that's, hopefully happens over time. I'm maybe being overly optimistic, but that those people who left the workforce are going to have the choice whether they come back and not, and where they're going to work. And that's, like you said earlier, as long as that's a natural kind of organic thing that happens, that's good for all of us, because it should make things better.
Yeah, at the end of the day, you want people happy in their lives,
right?
Where they're not machines. We want them happy in their lives, and if they're happier at making 5 or 10% less household income, but their quality of life has gone up, that's good. If they're happy about it.
Yeah, which, by the way, opens the floodgate of discussion about sort of remote work or people being able to move away from super expensive places to live to some place where they can buy a home and do the same job. I mean, that's a whole nother dimension of all of this. That
it's really interesting because we talk about that a lot. There's been we work on it with groups who are trying to do that in large parts of the country that haven't experienced it, and hoping to take advantage of it. But just see that a report out this morning of I think the headline was the new Silicon Valley is the old Silicon Valley. where, another $20 billion of VC money, went to firms in Silicon Valley. There was no shift to investments in other hubs and our beloved Pittsburgh or Boston, Boston or New York or Austin or wherever, sexy other tech hub that people had in mind. It's still overwhelmingly Silicon Valley. And so some things are going to stay the same, I think.
Well, I mean, but I'm not sure that answers quite the same question, because I think the company may still continue to be there. But I mean, I see it in Pittsburgh in
terms of where people are working.
Yeah, there's the house right next to mine was just bought by a family from Seattle who's moving here, but he's going to continue to work for the company in Seattle, right? I mean, how much that part, that's going to take a long time to play out. I don't think we're going to, and that the VC money is still going to go to where the company's headquartered, which will probably continue to be out there. But yeah, those shifts may be slow, but they're happening.
What else, guys? I mean, what do we have? What are we looking ahead to next week?
Fairly busy week. So we get both the CPI and the PPI in the United States. Big one with the retail sales and then industrial production numbers. China will give us their second quarter GDP. Bank of Canada and Japan have meetings. And then obviously we're going to be battling in the Senate and the House over infrastructure.
That's an infrastructure. It's infrastructure summer. It's going to be infrastructure fall, but at least it actually really is.
Yeah. For the first time, we actually are battling over it. We're not just saying we're going to do it and not do anything.
Yeah. All right. John Dick, any closing thoughts?
No, I mean, it's a tough time to try to predict the future. That's
my son and I are going to go see our Pirates play the Mets here at Citi Field tonight.
Oh, fun.
We'll be there. Yeah.
One of my favorite stadiums.
But it'll be my first time there, so I'm looking forward to it.
Oh, it's a great one. They did a good job with that one.
It's great.
All right, guys.
Thanks for having me again. It's fun to be here.
Thanks for joining us, as always. For John Dick, John Fagan, Brendan Walsh, and Tony Fratto, have a wonderful weekend. Thanks for listening to the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.